Hi, I'm Seth Rosenwasser, Senior Specialist within Nasdaq's Corporate Advisory Solutions, and I'm here with another TMT Pulse where we talk all things tech, media, and telecom. The latter half of 2018 was volatile for equity markets, with October standing out as the start of a decline that has remained largely in effect until today. As you can see here, the major U.S. equity indices had their worst annual performance since 2008, and only 2 of 11 GICS sectors, healthcare and utilities, finished 2018 in the green. The market's woes can be traced back to an escalation of ongoing trade disputes with economic titan China and resulting tariffs. These tariffs have started to flow through to company balance sheets and have put a damper on earnings power. Equity woes have also been exacerbated by China's economy, which has been showing signs of slowing down. This development has hurt valuations for stocks that need high growth rates to justify their multiples. Negotiations between the United States and China have been ongoing, but progress has been difficult, and the uncertainty surrounding the issue has been hurting companies that operate in almost every segment of the economy. The Federal Reserve of the United States has also been raising interest rates, as expected, which has added pressure to a stock market and an economy that has already been dealing with a myriad of uncertainty. All of these factors combined make for a difficult environment for higher growth tech companies. Apple has been hit especially hard, slashing its revenue guidance for the first time in more than 15 years as they cite slow demand for the iPhone in China as the cause. Possible slowdowns in future growth have caused a lot of companies to lower guidance. The upcoming earnings season will be a pivotal moment for the market as pundits assess the real impact by the slate of factors currently at work. Media and telecom firms have been dealing with their own host of issues, with M&A becoming a significant trend within the space. As companies vie for dominance over an ever-increasing competitive landscape, consolidation has become key. Despite all the negative issues at work, Nasdaq Intelligence has seen a large amount of institutional buying amid the broader equity market sell-off. Longer-term focused firms that invest on the behalf of pension funds have been quick to snap up companies that have suddenly become cheap due to the effects of quantitative and algorithmic trading within the marketplace. For much of 2018, many of these firms were sidelined as equity prices reached record levels. The recent pullback has been seen as an opportunity by many and not a sign of a broader systemic issue. As stated before, Nasdaq data suggests that much of the recent downturn has been a product of short-term traders and quant strategists that have been feeding off of the tremendous volatility the markets have been displaying. Since October of 2018, the VIX, which provides a measure of market risk and investor sentiments, has seen a notable increase. From this chart, you can see that volatility spiked in early October, which coincided with the start of the market swoon. However, since the start of 2019, volatility has dropped off significantly, and the market has begun to rally back. Nasdaq research suggests that the rally is the result of the opportunistic buying by the quality asset managers we alluded to earlier. Not all firms have been seeing opportunity in the market, however, and many hedge funds have been tightening their belts or closing down shop altogether. This is largely a result of a crowded playing field and an inability to outperform the S&P 500 and the continued popularity of cheap, passively managed index funds. This graphic details some of the hedge funds that have closed in 2018, along with their portfolio exposure to tech, media, and telecom. Speaking of the hedge fund industry, here are some notable winners and losers in terms of 2018 performance. According to Bloomberg, 6 in 10 hedge funds have lost money, the highest proportion since the 2008 financial crisis. About 40% of the funds tracked by Preqin lost more than 5%. As we head into 2019, investment activity from high-quality firms has been on the rise. The market has slowly been gaining back what was lost late last year. All major indices are in the green for 2019 so far as we approach the upcoming earnings season. The domestic economy appears to be on solid footing when all economic data is taken into account, so perhaps the stock market isn't as shaky as some will have you believe. As time reveals the truth, we at Nasdaq will be here to help you make sense of it all. I'm Seth Rosenwasser. We'll see you next time.